Investing might seem complicated, but what if there's a simpler, smarter way to grow your wealth over time? In today's video, we're diving into The Little Book of Common Sense Investing by John C. Bogle, the founder of Vanguard and the man who changed the game with index funds. This book breaks down the most effective way to invest and secure your financial future. And believe me, it's simpler than you think. We'll cover 5 key lessons from Bogle's investing philosophy that will help you make better decisions with your money. We're going to break down some of the barriers people have about investing and make this approachable for literally anyone watching this. Investing is the key to building long-term wealth, and the concepts in this book, well, they really are common sense. And stick around until the end. We're revealing a surprising, often overlooked mistake that many investors make, even with the best strategies in place. You might be surprised to hear this one, as it goes against a lot of what you hear from so-called financial gurus. So, if you're ready to unlock your path to financial freedom, let's dive right in. Alright, let's talk about index funds. Imagine trying to pick individual stocks, trying to guess which companies will outperform the market. It's like trying to predict the weather 3 months out. You might get lucky, but chances are you'll be wrong. That's where index funds come in. Think of an index fund like a basket of stocks that tracks a specific market index, like the S&P 500. Now, when it comes to index funds, lower costs are king. Every dollar you save on fees is a dollar that stays invested and working for you. Over time, those small savings can add up to a significant difference in your returns. We're talking tens of thousands, even hundreds of thousands of dollars in the long run. And the best part about index funds? They're incredibly easy to invest in. You can buy them through most brokerage accounts, and they require very little maintenance. So if you're looking for a simple, effective way to invest your money, look no further than low-cost index funds. They're the foundation of a solid investment strategy and can help you build wealth over the long term. Remember, in the world of investing, it's not about trying to beat the market, it's about joining it in a smart and efficient way. Index funds allow you to do just that. By investing in a diversified portfolio of low-cost index funds, you're setting yourself up for success and putting your money to work for you. Don't underestimate the power of simplicity and low costs when it comes to investing. Index funds are a testament to that, and they can be your secret weapon to building long-term wealth. So, are you ready to start investing smarter and maximizing your returns? Consider adding index funds to your portfolio and experience the difference they can make. Your future self will thank you. You know, everyone wants to buy low and sell high, right? It sounds so easy, but the reality is timing the market is incredibly difficult, even for professional investors. It's like trying to catch a falling knife. You're more likely to get cut than to succeed. Think about it. If professional investors with access to the best research and data struggle to time the market consistently, what makes you think you can do it? The truth is, no one can predict short-term market movements with any degree of accuracy. But here's the thing, you don't need to time the market to be successful. In fact, trying to do so can actually hurt your returns. Think about all the potential gains you miss out on when you're sitting on the sidelines, waiting for the perfect time to buy. Bogle understood this better than anyone. He knew that time in the market is more important than timing the market. The longer you stay invested, the more time your money has to grow and compound. Think about it this way, even if you miss the best trading days in the market, you're still likely to come out ahead by simply staying invested. A study by J.P. Morgan found that missing just the 10 best days in the market over a 20-year period could reduce your returns by as much as 50%. So, instead of trying to predict the unpredictable, focus on what you can control, your investment strategy. Develop a solid plan, stick to it, and don't let emotions dictate your investment decisions. Remember, slow and steady wins the race, especially when it comes to investing. The key takeaway here? Don't get caught up in the hype of market timing. It's a fool's errand that can lead to costly mistakes. Instead, focus on building a diversified portfolio, staying invested for the long term, and letting the power of compounding work its magic. Chapter 3. Stay the course. Let's face it, market downturns are inevitable. They're a natural part of the economic cycle. But here's the thing, they're also temporary. The market has always recovered from downturns in the past, and there's no reason to believe it won't continue to do so in the future. But during those downturns, it's easy to panic and make emotional decisions. You see your portfolio value dropping and you might be tempted to sell everything and cut your losses. But that's the worst thing you can do. Remember, when you sell during a downturn, you're locking in your losses. You're essentially selling low and buying high later on, which is the opposite of what you want to do. Instead, view market downturns as opportunities to buy more of your investments at a discount. Bogle believed that staying the course during market downturns is crucial for long-term success. He knew that trying to time the market by selling during downturns and buying back in later is a recipe for disaster. It's like trying to jump off a roller coaster when it dips down and then jump back on when it goes back up. You're more likely to get hurt than to succeed. Instead, just ride it out and enjoy the ride. So how do you stay the course when the market is volatile? First, have a long-term perspective. Remember why you're investing in the first place, and focus on your long-term goals. Second, tune out the noise. Don't constantly check your portfolio or listen to the doom and gloom predictions of the financial media. Remember, they're in the business of selling fear, not sound financial advice. Finally, have a plan and stick to it. Don't let emotions dictate your investment decisions. Remember, slow and steady wins the race, especially when it comes to investing. Chapter 4. Keep investing simple. The world of finance can feel incredibly complex, with all sorts of fancy investment products and strategies being thrown at you. But here's the truth: investing doesn't have to be complicated. In fact, the simpler your approach, the better. Bogle was a huge advocate for simplicity in investing. He believed that investors should focus on what they can control: costs, diversification, and time in the market. He knew that trying to outsmart the market with complex strategies was a recipe for underperformance. Think about it this way: the more complex your investment strategy, the more moving parts there are, and the more opportunities there are for things to go wrong. Plus, complex strategies often come with higher fees, which eat into your returns. So, how do you keep your investing simple? First, focus on building a diversified portfolio of low-cost index funds. This will give you exposure to a broad range of asset classes, helping to reduce risk. Second, automate your investments. Set up automatic contributions to your investment accounts so you're consistently investing, regardless of what the market is doing. This is a great way to take advantage of dollar-cost averaging, which helps to smooth out your investment returns over time. Finally, avoid chasing performance. Don't be tempted to jump from one hot investment to the next. Remember, past performance is not indicative of future results. Instead, focus on your long-term goals and stick to your plan. Remember, investing doesn't have to be rocket science. By keeping things simple, you can reduce your stress levels, save on fees, and improve your chances of success. Chapter 5. Focus on net returns, not gross. When evaluating investment performance, it's easy to get caught up in the headline numbers, the gross returns. But here's the thing: gross returns don't tell the whole story. What really matters are your net returns, the amount of money you actually get to keep after all fees and expenses are deducted. Bogle understood the importance of net returns better than anyone. He knew that even small differences in fees can have a significant impact on your long-term returns. That's why he was so passionate about low-cost investing. Think about it this way: if you're paying high fees, you're essentially giving away a portion of your potential returns to someone else. That's money that could be working for you, compounding over time, and helping you reach your financial goals faster. So, how do you focus on net returns? First, be mindful of all the fees associated with your investments, including expense ratios, trading commissions, and advisory fees. Don't be afraid to ask questions and shop around for lower-cost options. Second, consider the tax implications of your investments. Investing in tax-efficient accounts, such as 401(k)s and Roth IRAs, can help you keep more of your investment earnings. Finally, remember that time is your ally when it comes to compounding returns. The longer you stay invested, the more time your money has to grow, and the greater the impact of fees on your returns. So, don't be fooled by flashy marketing or high gross returns. Focus on what really matters: your net returns. By minimizing fees and expenses, you can keep more of your hard-earned money working for you and reach your financial goals faster. And now, the surprising mistake that can ruin even the best investing strategies: chasing performance. Many investors fall into the trap of jumping from one hot stock or fund to the next, thinking that the past performance guarantees future success. But the truth is, last year's winners are often this year's losers. Instead of chasing the next big thing, stick to your diversified low-cost investments and let time do the heavy lifting. To recap, here are the 5 key lessons from the Little Book of Common Sense Investing. 1. Invest in low-cost index funds. 2. Don't try to time the market. 3. Stay the course during market downturns. 4. Keep your investing strategy simple. 5. Focus on net returns, not gross returns. There you have it. How are you navigating through these common sense? Let me know in the comments section below. Thanks for watching.